Previously unthinkable is now fully possible. Bill Moist, MSCPA. Negative interest rates are spreading like a virus. Central banks in the Eurozone, Switzerland, Sweden, and Japan all have below zero interest rates. How is that possible? NIRP, as economists call a negative interest rate policy, is a desperate move. Did you get that? A desperate move, but the only move these banks think they have available. Negative interest rates are now fully possible in the United States. But first, let's discuss what NIRP means. Negative interest rates are an attempt by the central banks to push commercial banks to lend more money to business and consumers rather than maintain a large balance at the central bank that costs them interest. That's a crazy idea, isn't it? Said differently, these banks must now pay the central banks to keep their surplus cash accounts. Well, this doesn't guarantee that banks will lend more freely. If the underlying economy is not growing significantly, the banks are more likely to pass the cost on to its customers by charging them, listen to this, by charging them to store their money. Bank depositors may decide to hoard the money instead of being charged to keep it at the bank. Well, in Japan, negative interest rates are driving up the sales of safes, so it appears the hoarding has begun. And worse yet, negative interest rates have not appeared to stimulate economic growth in Europe. In short, future downward interest rates by European Central Bank will seriously impair the European banking industry, which could increase instability in European markets. Negative interest rate policy will most likely hurt European economic growth, not help it. So, why in the world would the Federal Reserve go down the same path as Europe? Is it impossible? Yes, many observers are saying yes, it is possible and likely in the next U.S. recession. Well, the Fed had a great gathering out at Jackson Hole, a great place to hang out for summertime. And the lead presenter, Marva Goodfriend, who's not your friend or my friend, in my opinion, of Carnegie Mellon, is a strong proponent of NIRP. His paper makes the case for unencumbering interest rates so that negative interest rates can be made freely available and fully effective as a realistic policy in future crises. What in the world does that mean? Well, in other words, Dr. Goodfriend thinks the bank should charge you to store your money, or at least have the right to charge you to store your money. He's no friend of mine. The Fed chair, Janet Yellen's own comments at Jackson Hole describing a monetary policy rule that would have sent rates down to a negative, listen to this, a negative 9% in late 2008. Clearly, NIRP is on her mind. In summary, previously unthinkable is now fully possible. The evidence appears the U.S. Federal Reserve will in fact consider using negative interest rates in the next recession. However, in my opinion, that won't help economic growth if there is no demand for additional borrowing. The author suggests that negative, oppressive regulatory policies and high taxes have a much greater impact on economic growth than negative interest rates will ever. A few industries that are currently being gutted by U.S. regulatory practices include medical, pharmaceutical, manufacturing, insurance, and construction. These industries have had major revenue declines and/or massive cost increases, leading to significant layoffs of workers. I personally know friends in those industries that are getting just hammered. So what to do to protect yourself? Consider higher interest rate alternatives to commercial banks, which may start charging you to keep your money. More on this in later editions of this newsletter. Our sources today included both Yahoo Finance and Fortune. Until next time, this is Bill Moist speaking. Previously unthinkable is now fully possible.